Let me ask you something. Before you walked into a dealership, did you actually know how much car you could afford? Or did you just hope the monthly payment would feel okay? Because most people skip straight to the payment and forget about everything else. And that's exactly how people end up broke with a nice car in their driveway. Today we're fixing that. By the end of this video, you'll know exactly how to figure out your number before you talk to a single salesperson. Let's get into it. Part 1. First decision, buy or lease. Before you can figure out what you can afford, you need to answer one question. Are you buying or leasing? Because these are two very different situations. Leasing means lower monthly payments. Why? Because you're only paying for the portion of the car that you use. It's depreciation, not the full price. You get to drive a newer car for less money per month. Sounds great, right? But here's the catch. You don't own anything at the end. There are mileage limits, and you're basically paying to borrow a car forever. Buying means you own the car. No mileage caps, no return in it. And when it's paid off, that monthly payment disappears. You can even sell it if you need to. Buying costs more upfront. But long-term ownership almost always wins. Neither option is wrong, it just depends on your situation. But knowing which path you're on changes how much car you can afford, so decide this first. Part 2. Your salary is the starting point. Okay, here's the part most people skip, doing the actual math. Your income is the foundation of your car budget, and there's a simple way to figure out your limit. Take your annual income, divide it by 12 to get your monthly income, then figure out what percentage you're comfortable spending on a car payment. Here's a quick breakdown. If you make $30,000 a year, a reasonable monthly payment is between $250 and $375. At $50,000 a year, you're looking at $417 to $625. At $70,000 a year, somewhere between $583 and $875. At $90,000 a year, roughly $750 to $1,125. And at $120,000 a year, you're in the $1,000 to $1,500 range. Now here's the key rule from the experts. Your car payment for a new car should be no more than 15% of your monthly take-home pay. For a used car, aim for 10%. And when you add in gas, insurance, and other car-related costs, everything together should stay under 20% of your take-home pay. That 20% number is your ceiling, don't go over it. Part 3, estimate your actual monthly payment. Now let's get into how your payment is actually calculated, because it's not just the price of the car divided by the number of months. Interest is a big deal here. The interest rate you get depends largely on your credit score. Better credit equals lower rate equals lower payment equals less money out of your pocket overall. For example, the same $30,000 car loan could cost you hundreds of dollars more per month with bad credit compared to good credit, just because of the interest rate difference. Before you shop, look up average auto loan rates for your credit score range. Then plug those numbers into a car loan calculator to see what different prices actually cost you monthly. This step takes maybe 5 minutes and can save you thousands. Part 4. Get pre-approved. Don't skip this. Here's one of the most powerful moves you can make before stepping onto a car lot. Get pre-approved for a loan. Go to your bank or credit union, apply for a loan, and get a letter showing exactly how much they'll lend you and at what rate. Now you walk into the dealership as basically a cash buyer. If the dealer wants to offer you financing, they have to beat what you already have. That completely changes the negotiation in your favor. When lenders review your pre-approval, they look at 3 things: your credit score, your income, and your debt-to-income ratio, which is just how much of your monthly income is already going toward existing debt. Pre-approval also tells you your real budget, not what a salesperson wants you to think your budget is. Know the difference between pre-approval and pre-qualification too. Pre-qualification is just an estimate. Pre-approval is an actual commitment from the lender. Part 5. The out-the-door price is what actually matters. You found a car listed at $28,000. Great, but that is not what you're going to pay. By the time you add taxes, title, registration fees, and whatever extras the dealer tries to tack on, window etching, paint protection, extended warranties, that $28,000 can easily turn into $31,000 or more. Expect the out-the-door price to be 10 to 15% higher than the sticker price depending on where you live. This matters because your loan is based on that final number, not the advertised price. So always ask for the out-the-door price up front. Most dealer add-ons are either worthless or wildly overpriced. You can say no. Do your research on what your state charges for taxes and registration before you go in. Knowing this makes you a much harder person to upsell. Part 6. Don't forget the other costs. Alright, this is where a lot of people get surprised. Your monthly loan payment is just one piece of the puzzle. Here's what else you need to factor in. Gas. Go to fueleconomy.gov and look up the miles per gallon for any car you're considering. A car that gets 20 miles per gallon will cost you noticeably more to fuel than one that gets 35. Over a year, that difference can be hundreds of dollars. Insurance. This one surprises people. The national average for auto insurance in 2025 is about $2,638 per year. That's over $220 a month. And that number went up more than 12% from the previous year. Different cars cost different amounts to insure, so check before you buy. Maintenance and repairs. All cars need oil changes, tyres and occasional fixes. Some cost more than others. Luxury brands are generally more expensive to maintain. Tools from Edmunds and Kelley Blue Book can estimate these costs for specific vehicles. Depreciation. This isn't a bill you pay monthly, but it's real money you lose. New cars lose value fast. Factor this in when deciding between new and used. Add all of these up. If the total pushes you past that 20% of take-home pay threshold we talked about earlier, you need a cheaper car. Conclusion. Here's the simple version of everything we just covered. Know your income. Set your percentage. Check your credit. Get pre-approved. Ask for the out-the-door price. And factor in gas, insurance, and maintenance before you commit. The goal isn't just to afford the payment. The goal is to afford the car, all of it, without it wrecking the rest of your financial life. A car should get you where you're going. It shouldn't stop you from getting where you want to be financially. If this helped, hit that like button and subscribe. We've got more money videos coming that'll help you make smarter decisions with every dollar. See you next time. See you.